Bitcoin's price has been incredibly volatile since launch, but that's because it's still an emerging asset class. Take gold, for example. It was just as turbulent when it started trading freely in 1971, after President Nixon ended its fixed link to the US dollar. That volatility can be hugely off-putting, but it's also what's driven the biggest gains for investors who've stayed the course and didn't panic sell when prices dropped. So let's look at the different ways you can invest, because each has its pros and cons. But there's something I really want you to remember. How you store your Bitcoin actually matters more than how you buy it. Get that wrong and you could lose everything. So the most common way to start is through a crypto exchange like Coinbase or Kraken. These are easy to use apps that you can download on your phone where you can buy and sell Bitcoin, just like shares or commodities. But there's a well-known saying in crypto: not your keys, not your coins. In other words, if you leave your Bitcoin on an exchange, it's really the exchange that controls it, not you. And if that exchange were ever hacked or shut down, you could lose access. That's why most investors move their Bitcoin into self-custody. And if you want to do this, you have two main options. First, you can store your Bitcoin in your own digital wallet, basically an app on your phone or computer known as a software wallet. And a couple of popular examples are the Exodus and Blue Wallet. And these hold your private keys. That's a unique digital code that proves that the Bitcoin is yours. They're really easy to use, which makes them a great starting point for beginners. The only downside is that because they're connected to the internet, they're more exposed to hacking. The alternative option is to use a small hardware device that stays completely offline. Think of it like a digital safe. Two of the most trusted ones are the Trezor Model 1 and the Ledger Nano X. They cost anywhere between £40 and £150, and they're ideal if you want to hold larger amounts of Bitcoin. Whether you're using a digital wallet or a hardware wallet, if you lose access, say your phone gets wiped or you lose your hardware device, you could lose access to your Bitcoin. That's why wallets give you a recovery phrase, 12 or 24 random words that let you recover your Bitcoin. So make sure to write it down and keep it in a safe place, because anyone who has access to those words also can access your Bitcoin. So the upside of self-custody is full control, but the trade-off is responsibility. If you lose that recovery phrase, there's no password reset, there's no helpline to call, and there's no way to get your Bitcoin back. So far, we've covered buying through an exchange and self-custody. Now, let's look at a final way to invest, through an ETN, exchange-traded note. ETNs let you buy Bitcoin without actually holding it yourself. For years, these were banned by the FCA, but as of the 8th of October this year, that ban has been lifted, which means that UK investors can now buy regulated Bitcoin and Ethereum ETNs. ETNs are listed on stock exchanges and issued by regulated firms like WisdomTree, CoinShares and 21Shares. You don't need to worry about wallets, passwords or private keys. The issuer does all that for you. One of the other benefits is that you can hold them in your ISA or your SIPP, so they're far more tax efficient than if you invest in Bitcoin directly. What's frustrating though is that even though the FCA's ban has been lifted, a lot of retail platforms still haven't opened up access. For example, Hargreaves Lansdown, the UK's largest investment platform, has said it won't until early next year. And the likes of AJ Bell, they're still reviewing their stance. When adoption does happen though, and it becomes more mainstream, expect to jump through a lot of hoops, because crypto ETNs, they are classed as restricted mass market investments. In other words, there'll be extra checks to make sure that people really understand what they're getting themselves into. ETNs are structured as debt, meaning you're effectively lending money to the issuer. In return, they promise to pay you an amount that tracks Bitcoin's value. So if Bitcoin rises, your ETN rises and vice versa. Because they work like a loan, you're essentially relying on the issuer's financial health. So if a company like 21 Shares or WisdomTree went bankrupt, you could lose access to your investment. That's why most issuers back their ETNs with real Bitcoin held in institutional grade custody to reinsure investors that their investment is secure. And since these issuers are regulated financial firms, you get greater protection than you would with most crypto exchanges. That said, ETNs aren't covered by the Financial Services Compensation Scheme in the same way as if you held Bitcoin directly. Whether you buy through an exchange, hold the Bitcoin yourself, or use an ETN, the key is choosing the best option for you. And don't just watch from the sidelines. Start small, even if it's just £10, to see how it works in practice. It's the best way to learn. In the next video, I'm going to be helping you get your head around Ethereum, what it is, how it works, and how it differs from Bitcoin. Thanks for watching, and don't forget to subscribe for more easy to understand crypto content. Many thanks.